Yeah. Let's look at the basic introduction to the world of securitization, which is one of the important innovations today in the financial markets. Just to understand the basic concept of securitization, any company which is having its various financial assets. A company which is having its financial assets, it's trying to sell off its financial assets to some third party entity, which actually is called as a special purpose vehicle. This special purpose vehicle is purchasing the various financial assets of a company and using this as the base, it is creating and issuing different securities to the market. So it is creating bonds based on the cash flows that are coming out of this financial asset and issuing the bonds in the market. So in a way, what is happening is the bonds that are issued by the SPV, they are fetching the cash for the SPV from various investors, who in turn is paying that cash to this entity and purchasing the financial assets of this entity. This is the overall process that is going in case of securitization. So any financial assets. So generally, probably if I'm talking about this as a bank, which has issued so many loans to the customers. It could be vehicle loans, it could be mortgage based loans, or it could be student loans, it could be any other loans. So this bank might have given different loans to different participants. So which means all the loans will actually become the assets of this particular bank. In some cases, even it might have given credit cards. It might so the credit card receivables also could be another asset of the bank. Now there could be an SPV, another legal entity, which would be purchasing all these financial assets of this bank, and using that fund it issues securities. So it is using the fund that is got from the securities from the market, using it to purchase the financial assets. So using that asset as the backup, where the purchased assets, which is the pool of loans generally, so that is used as a backup for making the payments to the bond investors. So why is this concept come into picture? Now, if I look at from a bank's perspective, it has given a lot of loans, and these loans would be paid at different points in time. The principal and the interest repayments may happen at different points in time. Until that point in time, the bank's assets are completely illiquid, right? Because generally in all these cases the bank would have kept the vehicle as a collateral. In case of vehicle loans, it must have kept the building as a collateral. In case of mortgage backed loans, all these are illiquid assets, and until the borrowers keep paying. In some cases there could be a 5-year payment period, it can go to 20 years, or it could be even a 30-year payment period. So the borrowers keep paying the interest and the principal at regular periods of time. Until that particular point in time, the assets are illiquid, and probably the bank has to wait until it receives the cash flows. Whereas now when it has sold, there is again a ready cash that has come into the bank, which means it can actually give more and more new loans. That's one motive behind this entire securitization. And on the second case, the cost, let's say for this bank, if it wants new capital, if it wants new capital and it wants to raise capital from the market, it would be pretty expensive because it's a fresh debt kind of thing that has been raised. Whereas in this mechanism, it's like selling the existing assets to the third party, which means it's a kind of collateralized kind of a borrowing that it is doing. These financial assets are acting as a collateral for raising money. So because the collateral is very strong, the cost of raising funds become lesser and lesser. So that's one of the prime reasons. So in a net, I could see the major motivation for securitization is the conversion of illiquid assets to liquid, and the second thing being the cost of funding, it can quite comfortably be reduced. So with this as a base, the securitization industry has flourished quite heavily in the last 1 decade. So any kind of loans can be securitized. Most commonly, I see the mortgages being securitized, and whenever these mortgages are securitized, and any SPV that has purchased these mortgages and issued the bonds or any other securities based on them, we call them as mortgage-backed securities, MBS, mortgage-backed securities. And if the same stuff has been performed with respect to any other assets apart from mortgages, the same logic, SPV has purchased those assets, and using that as the base, if the bonds have been issued, we call them as ABS, asset-backed securities. Now, because of these, what is happening in a general banking system, right? Let's try to understand the general banking system. The depositors, regular customers, they are depositing their money into the bank, different kinds of deposits for which they get different kinds of interest rates. Sometimes it could be majorly it's a fixed or a little bit of floating. In turn, the banks are using this fund, whatever got through various deposits or sometimes through some borrowings. The fund that has come into the bank, it is getting used to issue the loans, different kinds of loans. It could be an automobile based loans, it could be mortgage based loans, or it could be student loans, it could be agricultural loans. I can think of many kinds of loans which the bank is issuing. Now, these people's money who have deposited is being used by the bank to lend. So these people, they are getting almost a fixed rate of return and are not getting a direct exposure to the bank's loans. Right? They are not becoming a direct lenders. The bank is taking the risk in this process in terms of lending, but from the depositor's perspective, there is a lot of safety. They are not getting a direct exposure to this, which means they are not taking any risk, so they can't get a higher return because they are not taking any kind of a risk. Now, this securitization is actually bridging the relationship between the lenders and the borrowers directly. Right? And because of this, the risk, instead of the bank taking the risk here, it is transferring the risk directly to the lenders itself. So the lender, it is acting as an intermediary in the process between the borrowers and the lenders. And because of this, for the lenders, the cost of lending, they are going to get a much better return because they are going to take a slightly higher risk in the process. And from the borrower's perspective, the cost is going to be much lesser because one layer is completely removed off. So intermediation costs, because now the bank is no more taking the risk, it's only doing the facilitation kind of a role, and because of this facilitation role, the intermediation costs or the intermediary costs are typically going down, which is resulting in overall lenders getting a slightly higher rate of return and borrowers getting it for a slightly lesser cost. And even if you look at it from the other perspective, whatever the loans that are being sold to the SPV, and that is what is being invested by the different investors through purchasing the bonds, they have a direct access on these loans. In case the company is not doing well, in case the bank's ratings have gone down, or bank is going into a default or any other stuff, these people, instead of having a general claim on all the assets of the firm, they have specific claim on all these loans, the financial assets which have been securitized. So that's a much better seniority that is coming as a part of their settlement process. And these bonds, they are actively traded in the secondary market. That's one more benefit that can come. The liquidity is getting increased quite drastically. And because the bank is receiving the proceeds much before the payment of the interest and the principal, the bank is getting more money so that it can lend more. The volume and the growth of the business is much higher for the bank in this particular case. And these bonds, they can be structured. Probably the SPV could structure the bonds depending of different maturities, of different coupon payments, of different priority in terms of the payment. It could very well be structured to suit the investment needs of different kinds of investors. So which means a better matching is coming, a better availability of the sources of funding is coming. All these things, rather than just looking at a fixed deposit or any other regular saving deposits with the bank, new avenues are coming up which are creating the required amount of exposure to the loan portfolios of the bank. So on one side, it can even act as a diversification, because you can very well plan out how much risk you want to take, and based on the additional risk which you are willing to take, you can structure the type of bonds accordingly, because this structure will provide bonds of different maturities, different coupon structures, and different priorities in terms of payment. So rather than directly purchasing the loans, going through an SPV route and purchasing the bonds that are issued by the SPV will definitely create a much diversification and a risk reduction for the investor. So just to quickly understand the various processes as a part of the summarization, I will take a case of a bank which has issued the loans, right? Probably it has given different kinds of loans to different borrowers. So all those loans become the assets of the bank, right? Now this bank has sold all these assets to an SPV. Now this SPV might have been created by the bank itself. The assets are removed from the balance sheet. From the balance sheet, these assets are removed and are transferred to this SPV. Now, for the SPV, that assets, whatever it had, it uses those assets as a base, and it actually issues the bonds in the capital market, right? And so in this case, the bank is called as the originator, whereas the SPV in this case is actually the issuer of the asset-backed securities, or sometimes we call it as the trust, they are doing this process. And this SPV as a word itself is special purpose vehicle. So this is created exclusively for purchasing the loans from the bank and issuing bonds out of that assets. So it's purely, its purpose is only for that much. And it has created the bonds which are called as asset-backed securities and sold them to the investors. And depending on the payments that the borrowers are making to the bank here will act as a servicer. There could be a third party also which acts as a servicer. Servicer is a party who takes care of collecting the payments, interacting with the borrowers, mentioning about the due dates, etc. They are responsible for the collection of the EMIs or the interest and the principal payments on the loan. So this comes in, and the principal and the interest, and if at all the servicer is a third party, some portion goes as the payment towards the servicing party, and this amount whatever comes, the interest and the principal, they go towards the payment for these bonds, right? They go towards the payment. Now this is where, instead of issuing all bonds of one type, there could be multiple types of bonds that could be issued, which could have the different payment structures. Payment structure could be different, the maturity period could be different, the risk levels could be different. All these things could be different for different kinds of bonds issued. So in some cases, which are riskless kind of bonds, probably the interest rates could be much lesser. Slightly risky, the interest rate could be slightly higher. More and more risky kind of bonds, the interest rates could be much more higher. Why is this more and more risky coming in? Whatever the payments that are coming from the borrowers, they can be structured in such a way, the first this group will be paid, and after that if there is something that is still left after payment to this group, the payments will happen to this group, and even after that if something is left, the payments will go to this. So but if the customers have defaulted heavily here, the amount did not come sufficiently, it might so happen that only this group will receive the payments. This group, to some extent, part payments might be received. This group may not receive the payment at all in a particular month. So this group is exposed more and more to the risk, whereas this group is much less exposed. So which is again resulting in the yield being much lower for this group, slightly higher for this group, very high for this kind of a group, right? So this is how a typical securitization structure is looking like. Every payment that is coming in the form of principal and the interest payment, if at all a third party servicer is there, the payment goes to that as per the agreement, and after that everything is paid towards servicing the ABS. And these different payments, because first the payment happens to this group, then this is, then to this kind of a payment structure is we call as waterfall structure. Just like a waterfall, initially the first group gets paid. The groups are actually called as tranches. So the first tranche gets paid, then the next tranche, then the next tranche. The risk levels of each of the tranches are also different, right? So here one thing we have to remember is the payments are happening exclusively from the cash flows that are coming from these assets itself and nowhere else. And this SPV is a pure legal entity, separate legal entity. So this is buying only the loans of this company. So anything else of this company has no relationship to this. So even if so from these bond issuers or bond investors perspective, they have a claim only on these assets and not other things about the firm. So even if this company has done some additional loan, Even if this bank has taken some additional loan to give some more additional loans, or it has raised some other capital to issue some new loan, and it has increased its risk, this SPV is really not bothered of, because it has already purchased some of the loans for some price, and only using that loans as a base these bonds have been issued. So the new loans don't get created or don't have any kind of an impact as a part of the ABS structure. So even if the financial health of this particular company is degrading, even if the financial position of the originating bank has gone down, the bond in ABS investors need not worry, because the ABS investors primarily are based on the SPVs purchased assets from the bank, which has already happened. So any kind of a degradation that has happened to the original bank does not impact the payments to the ABS investors. That's one of the reasons the credit ratings associated with the ABS generally we find will be much better compared to the credit ratings that are associated with the underlying bonds itself. And that is one more reason the cost of funds for the SPV borrowing through ABS, the cost of funds would be much lesser compared to the bank, underlying bank directly raising the loans from the market itself. So because of all these various advantages that are coming in, and because of the mechanism of transferring the risk from the bank to the lenders or the depositors itself, the overall costs are getting minimized, and from the bank's perspective, the illiquid assets are getting liquid, which is enabling them to grow their business quite at a faster rate, right? So that's how the securitization had created a lot of inroads into the current financial world, and it is becoming an inevitable portion of majority of the financial transactions. All right. Now let's talk about residential loans or residential mortgage loans, for which the typical collateral is the residential real estate, the property. Which means if a borrower has defaulted, the lender typically will have the access to this collateral. So a key characteristic that we typically see in this residential mortgages is the loan to value ratio, typically called as LTV. So as the word itself is saying, compared to the value of the house or value of the property, what is the loan amount that is taken? So higher the ratio is, the riskiness is associated with the lender, and the lower it is, probably it is considered to be more and more secure, because the value which acts as a backup, even if the value falls to a decent extent, the loan can very well be recovered. Whatever the amount that has been given as a loan can very well be recovered. So the lower is the ratio, the borrowers, from a borrower's perspective also, we see his stake is much higher, so very less chances that he will default. And from the other perspective also, if the value of this property is very high, LTV ratio is low, means the value of the property is very high compared to the loan taken. So even if this value falls down drastically, it will still be sufficient to recover the loan. So that is one major thing. And from the other side, if I look at, for the different kinds of loans, different kinds of terms and conditions, different kinds of structures are associated in different countries. And the way the interest rate changes, the way the principal is amortized, different kinds of key characteristics that are associated with the residential mortgages. So initially to look out, how do I look out from the maturity perspective? Maturity is one important aspect that is associated with the residential loan. We see it's basically the time until which the final loan payment will be paid. So it could be anywhere between 15 to 20 years, or in some countries it can go even to 30 to 40 years. And probably in Japan kind of countries, I see even these going up to 100 years. So typically, the different term to maturities are available with the different residential mortgages. But the major factor that's a driver in the majority of the residential mortgages is the interest that is charged. Either it could be on a fixed rate basis, or it could be on an adjustable rate or a variable rate kind of a basis. So when I'm talking about a fixed rate, whatever is the interest rate that is charged, that is fixed over the life of the loan. Whereas when I look at the adjustable, or probably calling it as a variable rate mortgage, now here the interest rate can keep changing. And within that, I'm specifying, let's say, if I'm specifying index referenced kind of an index reference kind of mortgage, then this variable rate can change based on a reference rate, like a LIBOR. As the LIBOR changes, even this rate can change. Whereas in some cases, it could change irrespective of the change of this. So wherever it is index reference, the interest rate will change based on some kind of a reference, market based reference like LIBOR. And today, these residential mortgages are structured in pretty different ways. Probably there could be a situation where it is fixed for some period, and it becomes floating or adjustable after that. Probably for the first few years, the interests are fixed, and they become adjustable later. In that case, we call these kind of mortgages as hybrid mortgages. There is another structure typically called as rollover mortgage or renegotiable mortgage, wherein I see that initially there is some fixed rate that is being set, and for few years, and after that I see that it gets changed to another fixed rate, either higher or lower, which is what will work out to a renegotiable kind of a mortgage. Then there are a few terms and conditions regarding the interest rate, wherein the option exists with the borrower. There is an option that is provided to the borrower, whether he wants to continue, whether he would be going ahead with an adjustable rate mortgage or a fixed rate mortgage, which he can choose after a certain point in time. So that is what we call as convertible mortgage. If he wants, he can change it to the other form. Initially, it could be either fixed or adjustable, along with an option. If the borrower wants, he can change the fixed to adjustable, or he can continue with the fixed. Initially, if he had taken an adjustable one, he can either continue with the adjustable or he can convert it into fixed. It is at the option of the borrower. So that's one more thing that is existing with respect to the fixed rate, with respect to the interest rates. So what we see in the residential mortgage market is the interest rate with these various terms and conditions is playing a very crucial role. Then another differentiator between the different residential loans is how the principal is amortized. how the principal is amortized. So first of all, initially there could be a fully amortized kind of a mechanism versus partially amortized. Whenever I talk about fully, we are making sure that whatever the payments that are being made, they consist of both the interest component as well as the principal component. So some portion of the principal is getting repaid in the earlier periods, and it is done in such a way that at the end of the period no principal is outstanding. At the end of the loan period no principal is outstanding. And generally whenever we are talking about the fixed payment, EMIs, equal monthly installment, equal yearly installment, if the payments are fixed, what we typically see is initially the interest component will be higher first few years, and in the later years the principal component will be higher. So what we would be logically seeing is the interest component keeps falling like this, the principal component keeps rising like this, whereas the total amount that is getting paid, which is a summation of these two, will remain flat. On the other side, I could very well have a partially amortizing. Again, here also there is an interest payment, there is a part principal payment that is being done, but at the end of the period, there is some principal amount that is outstanding and a lump sum needs to be paid. And anytime I am paying a lump sum payment, we are calling it as a balloon payment. So in a partially amortizing, at the end of the period, there is a lump sum amount that I still require to pay. Whereas there are some kind of mortgages which are purely interest only. So in this interest only, every period I pay only interest. No partial payment of the principal at all. Which means over the entire lifetime, only the interest is being paid, and on the end, the full principal amount, whatever was taken at the beginning of the period, that entire amount, which is the original loan amount, needs to be paid. So, or in some cases, there could be a combination. Probably it may say that initial 5 years, it's an interest only kind of a loan, and after that, for the next 20 years, the principal is amortized. They could say that it is partly amortized, or they could say it is fully amortized. All kinds of combinations can very well be worked out in this case, right? So how the principal is getting amortized is one more major aspect of the residential mortgages. Then what is the kind of provision they provide with respect to the prepayments? One more important aspect for us to look at. See, whatever we are talking of, if it is a fully amortized or even a partially amortized kind of a loan, we have been talking about that there is an interest payment and a part principal payment that is being done. So this part principal payment, whatever is getting done, is called as the scheduled principal payment. But in some cases, people may try to pay an excess over this scheduled principal payment, and whatever this excess is getting paid either to close the loan early, or because they have high cash with them, they want to close the loan early, or probably they want to get into refinancing of the loan. Probably the interest rates that are available now have gone down significantly, and the existing loan is costing them heavily, so they want to close out the existing loan and open a fresh loan. In these kind of cases where they are repaying the principal faster than the schedule, that is what we consider it as a prepayment. Any repayment of the principal faster than the scheduled is what we are calling as the prepayment. So it can happen when the person wants to sell his house. If he has sold the house, he got the money, and that money can be used to pay back the loan, or he can get into a refinancing. As I have already said, the interest rates are cheaper, and he would like to raise a loan with a lesser interest rate. So whatever the new amount that he has got through the new loan, he would be using to pay back the existing loan. So in some cases, there is a heavy cash and I just want to get rid of my liabilities, so I'm going to pay back the loan. And the more and more I'm repaying the principal, the interest component is getting reduced. The more repayment of the principal done, the interest component is getting reduced, and overall the loan is closing early. So that's the major motivation, and that's a big loss for the lender, because lender has planned a schedule that he would be that company would be receiving the interest and principals at these kind of predefined period. But now getting it early, and that too when a period where the interest rates are much lesser, reinvestment could be a big problem for the lenders. And that is where in some cases they may charge a penalty in case the prepayment is happening. In some cases no penalty could be there, but there could be a prepayment penalty in some of them, which means in case the loan is paid early, either during a specified period or during the entire period. In some cases, this is what is being specified in the contract. In some cases, this is what. If you repay, if you do a prepayment very early, it will have some penalty. If you do a prepayment at any point in time during the life of the mortgage, there could be another kind of a penalty. And majority of the times what we see is because the prepayments happen, especially when the interest rates are much lower, this would be a kind of compensation or a benefit that acts for the lender, and lender is getting slightly better off because of this prepayment penalty. Then one more dimension that typically works out is whether this loan is a non-recourse loan or a recourse loan. In some cases, the loans work on a non-recourse basis, which means the lender has the access to the assets. Lender can claim only the assets of the borrower and not the personal wealth. Not the personal wealth of the borrower. So in case the borrower has defaulted, the lender at the max can take the possession of the house and not anything else of the borrower. Whereas in case of recourse, that is not the case. Lender can really claim anything of the borrower. It's just not the house or the possession of the property. He can sell the property, and any shortfall he can recover from the borrower. Those are recourse kind of loans, which means in recourse loans the risk is much lesser, because any shortfall on the value of the property can very well be recovered from the borrower through the other assets of the borrower. Whereas when we are talking about a non-recourse loan, except the property that has been set aside as a collateral, nothing else can be possessed by the lender. So this can very well result even in a strategic defaults as well, because if the value of the property has gone down drastically, much lesser than the principal to be repaid, the borrower can very well hand over the asset to the lender, saying that he will not be able to repay. So the value what would be possessed by the lender is the property whose value is less than the amount of principal that needs to be repaid, and that is where a strategic default is coming into picture. So the scope of default is much higher in non-recourse kind of loans compared to a recourse kind of loan. So while getting into a residential mortgage, all these different aspects need to be considered significantly. All right. Now let's look at the residential mortgage-backed securities. So it's again a typical asset-backed security with a pool of residential mortgages which are sold by the bank. Bank has lent to various borrowers and it has created a big asset. A pool of mortgages have been created as a big asset. These assets are being sold to the SPV and who has in turn issued the bonds to the investors in the capital market. And these kind of bonds are what we are calling as residential mortgage-backed securities because the asset that is underlying them is the residential mortgage. And in the typical sense, we see the two major agencies or two major entities getting into this residential mortgage-backed securities. In the United States, you call them as agency RMBS, residential mortgage-backed securities, or non-agency. Whenever I am using the word agency, it is purely associated with again either government or government sponsored enterprises. So whenever I am talking about a government, it is the payments are fully backed by the government. Whereas even in this case, government sponsored entities, even if it is not fully backed by the government, they have a very good credit quality. So generally Fannie Mae and Freddie Mac, they come under the government sponsored enterprises, whereas Ginnie Mae is a complete backing of the government itself. And similarly, in the non-agency case, anything that does not fit into the agency RMBS, we'll talk about what makes it fit into the agency RMBS structure. But anything that does not fit into the agency RMBS structure, it has to go as a part of the non-agency, which in which case these are typically issued by the private organizations and they are more risky because they are not backed by the faith of the government or they don't carry that much of credit quality which a typical government sponsored enterprise carries. And in majority of the cases or all the agency based RMBS, they are mortgage pass through securities itself. Whenever I am talking about the pass-through security, as we know, whatever the payments that come from this particular loan portfolio, loan pool, they are used to make the payments to the investors. So the investors can typically claim the cash flows of this pool. And here, when the pool is created purely based from residential mortgages, we call this kind of an instrument as a residential mortgage-backed security. And this pool can have any number of loans, any maturities. So it's a kind of a combination of different kinds of loans that can come. So all this entire pool, this entire pool can contain any number of security mortgages. Those kind of loans which are being sold as a part of the pool, they are called as security mortgages, and this pool can contain any number of security mortgages. And for this, for this pool, we have a few things to find out. One, a weighted average maturity period. So now I could see that this pool of loans are packaged, sold to this entity, and this entity has created different kinds of bonds and sold to the investors. So I require the weighted average maturity period of this entire MBS. So the weighted average maturity is again the weighted average of the maturity of all the loans that got into the pool, and the weightage is computed based on the principal value of all the mortgages. So let's say if there is a mortgage worth 2 million for a 5-year period, there is a 5 million loan which is outstanding for 10 years. There is a 20 million loan, or there is a 3 million loan which is outstanding for 20 years. Now, if I have to find out the weighted average maturity for this entire loan for this mortgage-backed security, I am taking the weighted average of all the loans that are underlying this mortgage pool, and with the weightages based on the principal value. So 2 out of 10, 7 and 10, 2 out of 10 multiplied by 5 plus 5 out of 10 multiplied by 10 plus 3 out of 10 multiplied by 20. So this is 1, this is 5, and this is 6. So the weighted average maturity period for this mortgage-backed security is typically 12 years. You getting it? So that's how we compute the weighted average maturity period, and at the same time we also compute the weighted average coupon associated with this MBS. Again, that is taken based on the weighted average of all the interest rates. So some of them may be having an interest rate of 8%, some of them 9%, some of them 5%, some of them floating. So weighted average of all the interest rates in the pool. So based on the quality of the loans, the payment to these parties is typically coming into picture. So whatever is the strength of the guarantee that is being provided to the various loans in the pool will assure the payments to the investors of the bond. So that's the reason any agency issuing the residential mortgage-backed security, it specifies a few important criteria. Any loan to be included as a part of agency-backed MBS, it has to meet a few important requirements. One, there should be some amount of down payment. It will specify how much of down payment has to happen. So in a way, it is talking about the loan to value ratio. At the max, it can be some number. Anything above this will not be accepted into the RMBS pool. And the size of the loan. What is the maximum amount that can be borrowed? Anything beyond that is treated as a risk, so it will not be included into the RMBS. What is the kind of documentation that is associated with that particular property? What is the kind of insurance? Is the insurance purchased for that particular property? The higher it is, the insurance is purchased, means it's a security, it's a secured kind of secured kind of a property. So it's a good chance that these kind of properties will be included as a part of the mortgage pool for issuing the MBS. So whenever any property is satisfying all these things, the loans which are underlying these kind of properties are called as conforming loans, and to a large extent the agency backed MBS will typically go with all these conforming loans itself, and anything that does not go into the conforming have to go via the non-agency backed MBS itself. And now when I look at it from the investor's perspective, whatever the cash flows that come, right, this is where I see the mortgage pool. This is what is an SPV purchasing that, and these are the bonds. From the mortgage pool, whatever the principal and the interest payments that are being done by the various borrowers, that would be transferred to the bond investors probably on a monthly basis. In case there is some kind of a servicing fee, or in case there is some kind of insurance premiums, any other guaranteeing kind of cost, they would be deducted, and rest of it is being paid as a payment to the bond investors. So the timings of payment to the bond investors may or may not be the same as the timing of payment by the borrowers. So, and because these fees are typically being paid, what would be received by these investors is slightly lesser than what is being paid by the borrowers. So, the net interest rate or the net coupon that these people are receiving, that the bond investors are receiving, is lesser than the interest rate that is associated with the mortgage pool, because there are some servicing costs, there are some guaranteeing costs which typically need to be paid before the payments from the underlying are passed on to the bond investors. And even the timing, probably these people would be paid, let's say, on a quarterly basis, but here it might so happen that every month there are some payments coming up. Even if this is instead of quarterly, even if it is mentioned here that the bond investors also would be receiving on a monthly basis, the exact time may not be matching, right? The delay from different people here may be paying at different points in time. So by the time this is getting transferred to the bond investors, there is a time delay that comes into picture. Along with that, all these mortgage-backed securities, they are more and more exposed to prepayment risk, because to a large extent in any mortgage there might be a possibility of a prepayment, people trying to pay off their loan early. So there is some kind of a plan that is associated with the prepayment. There is there is some kind of an expectation based on the historical data regarding the prepayment, but in some cases the prepayments would be much faster. The prepayment rate is more than the expected. Prepayments are happening faster, which is resulting in a contraction risk, right? Prepayments are happening more and more faster, means the reinvestments are becoming tougher, and it's resulting in a contraction risk, whereas in some cases the prepayments are slower than the typical expected, which means the by the time I get my whole loan payment, it is more number of years. That's the reason we are talking of extension risk. See, if the prepayments are faster, I'm going to get much earlier. The loan is getting to get closed much earlier, which means the bond investors are going to get their entire principal back much earlier. Means their bond maturity is happening much faster. That's the reason they are exposed more and more to contraction risk. If the prepayments are slower than expected, then the bond investors are going to receive their payments much later, so they are exposed more and more to the contract extension risk, right? So because of these prepayments, there is a lot of uncertainty that is getting developed, right? Both in terms of when I will receive the payment and even how much I am going to receive, because the borrower can very well repay any amount any point in time. So there is a lot of uncertainty, and that has to be handled much more effectively. There are a few measures to typically expect some amount of prepayment. There is a metrics called single monthly mortality. There is a metric called single monthly mortality, SMM, which talks about the percentage by which that excess prepayment can happen. Whatever is the prepayment that is done, the percentage by which the prepayment done, it will reduce the principal balance. So by how much is the principal balance getting reduced because of this prepayment, and compared to if there has not been any prepayment. If there has been prepayment versus if there has not been a prepayment, what is the change in the principal outstanding at the end of the period? That is what we are calling as single monthly mortality, and the single monthly mortality is typically annualized, which is typically giving me what is called as a conditional prepayment rate. So on an average, in a particular year, we are expecting that the prepayments are going to be somewhere around this percentage. And of course, the prepayments, in general, I can put it in this way, but more and more specifically, they are based on the weighted average coupon, because the higher is the interest rate, the coupon, the prepayment may not be much higher, but the lower the interest rates go up, there is a possibility of more and more prepayments happening. The current interest rates that are prevailing, and already if the prepayments have been done to a large extent, even that will have an impact on the prepayment rate now. So regarding this prepayments, there is a Public Securities Association benchmark. So what this PSA benchmark talks of is, for different pools of mortgages, they said what should be the monthly prepayment rate. They have set for different kinds of mortgages, what is the kind of monthly prepayment rate, and it is typical, or it is generally expressed as a part of the conditional prepayment rate. And what they say is, for each month, according to the PSA, for each month there should be a different CPR, because what they have really researched out is the prepayments rates are much lesser in the initial periods of the loan, but as the loan is getting more and more seasoned, getting more and more aged, the prepayment rates are typically going up. So it is typically following some such kind of a mechanism. Up to the first few years, initially the prepayment rates are much lesser, they keep increasing with the age, and after that, for next until the maturity, they are remaining more or less flat. But they have come out with a kind of a benchmark. So when the benchmark is PSA 100, is like an index. So any kind of a mortgage pool that is typically going with this kind of a benchmark, obviously will be more or less closer in terms of the prepayment rates following this kind of a pattern, whereas in some cases they could be much faster than this, they could be much slower than this. So the prepayment rates are expressed in terms of the PSA. Sometimes we say if the PSA is 150, it means the prepayments are 1.5 times the benchmark. So if the benchmark is saying that the CPR, let's say 6 months from now, the 6 month CPR is going to be 3%, what this particular mortgage backed security will be having is 4.5% would be the amount of prepayments that are coming in. So we typically see that the prepayment rate can be expressed with respect to the PSA benchmark, and the actual prepayment can very well be tracked with respect to that particular benchmark. And based on what is the prepayment rate, we can talk about the average maturity. So if the prepayment rate is much faster, we see that the maturity period is going to come down. So the weighted average life of the MBS is going to come down in case the prepayment rate is going to be much higher, and vice versa. And typically when the interest rates are falling, to a large extent people do the refinancing of their mortgages, so they try to do prepayments at a much faster rate, which will result in reduction of the average life to a very drastic extent. the higher the psa the lower is the average life of the mortgage backed security, and vice versa, right? Now, when I talk about the non-agency, as I said, they are all not guaranteed. So, credit risk is a very important aspect in a non-agency backed security. And the loan to value ratios could be much higher. If it is much lesser, there is a high chance that it would have been included as a part of the agency MBS as well. So, the credit quality of the borrower, the loan to value ratio, all these things are risky in a non-agency backed security. That's the reason, in case of non-agency, to really attract the investors to invest in the non-agency backed securities, the non-agency MBS issuing companies, they try to get into some kind of credit enhancements. And these enhancements are going to work on the ratings of that MBS. They are going to improve the credit ratings of the MBS. So depending on what is the kind of credit rating that is being expected for that MBS, appropriate credit enhancements need to be provided. And what I typically see is these enhancements, some of them are external in nature and some of them are more internal. Any external is like a financial guarantee from a third party, and generally this kind of a financial guarantee is expected from a monoline insurance company. Insurance company that is purely set up, or whose pure objective is in terms of providing the insurance against all the defaults on the MBS. Right? So, the major line of business for this insurance company should be insuring all these ABSs and MBSs and providing the finance, or providing the compensation of the loss against the default for default on all these MBSs. So that's the kind of a financial guarantee that is expected, that will improve the ratings of the MBS. And when I'm looking at from an internal perspective, either there could be reserve funds. So when we talk about from the issuance, when I have issued the bonds, there are proceeds that have come, the issuance proceeds that have come, and this excess cash is actually put into a reserve account. And this reserve account is used to fund for the losses whenever occurring, or it can come out through excess servicing spread funds. Again, it is a kind of an excess spread. See, whatever is the payment this entity has to do to this RMBS investors, the rate, let's say this payment is at 5%. 5% is the payment or weighted average coupon that needs to be paid to the RMBS investors. Whereas from the borrowers, it is going to get, let's say, 7% on an average. So this excess spread, that is again taken into a reserve account, and that reserve account is again used to fund for the losses. But if the default rate is much higher, so the weighted average of this will go much lesser. So excess spread cannot exist, or it completely diminishes, or it can go negative as well. So care has to be taken in terms of properly assessing the default rate. And in some cases, one of the better way of internal enhancement is the process of over collateralization. The ABS or MBS is issued. See, let's say if the worth of all the properties here is 100 million, the MBS is issued only for 95 million. A 5 million haircut is being observed. So the worth of the collateral is much more than the worth of the MBS or ABS that is issued. Because of this, what happens is, in case defaults occur, right? In case defaults occur even to the extent of 5 million, no problem. Because what is the typical liability towards the various MBS investors is only to the worth of 95 million. So a 5 million default, no one is absorbing the losses. Anything beyond 5 million only, the losses will be absorbed by the investors. So the over collateralization helps in a large extent. It will increase the credit worthiness of the ABS, and it will definitely improve the ratings of the ABS. And along with that, there could be a senior subordinated kind of a structure. Instead of treating all the investors in the same way, the senior subordinated structure. So first of all, let's say the asset, these are the mortgage pool, which is worth 100 million. So this entire mortgage pool is purchased by the SPV, and SPV has issued bonds, let's say to the extent of 90 million. Right, which means an over collateralization is being done to the extent of 10 million. And even in this 90 million also, it has created, let's say, three structures. Senior tranche worth 50 million. There is a subordinated one tranche which is 30 million, and subordinated two tranche which is 10 million. Let's say such a kind of senior subordinated structure has been created. So in this, what is happening is, okay, now if the losses are coming up, if these guys have defaulted on their loans, for the first 10 million no one is affected, because only 90 million has to be paid towards this MBS investors. Now, if the default is more than 10 million, first the losses will be observed by this tranche. So, any loss, any total default between 10 to 20 million, 10 million is going towards the over collateral, and the remaining between 10 and 20, that would be absorbed by the subordinate tranche 2. And anything beyond that, that too between 20 and 50, if it is the default, then it would be absorbed by the subordinate tranche 1. And only if the default is more than 50 million, the loss will be transferred to the senior tranche, which means from the payments wise, the first 50 million, whatever is received, will go to this group. The next 30 million, if at all it is received, it goes to this group. And finally, after 80 million, anything excess that is received, that goes to this group. So the loss is completely redistributed. Right, the loss is completely redistributed. This group absorbs the loss heavily, so there is a high risk that is built for this group. There is a moderate risk for this group, and this is almost a less risky kind of a group. Right, so there is a kind of a change in the structure like this. And along with this, we can even talk about, there might even be a provision for the shifting interest mechanism. In case In case this group is not able to do the protection to the required extent, right, and this particular group is facing some amount of risk because of the decrease in the value of the credit enhancement. It can so happen that the payments to this group can be suspended also. The payments to this group can be suspended until the full payments for this group are restored, the credit quality is back to the normal, and only then the payments again can be backed to this subordinated kind of tranches. So there could be a shifting interest mechanism as well, which clearly says in case the whole MBS has lost its credit quality and the senior debt is sensing some amount of riskiness, or credit quality is getting worsened, it can so happen that because of this shifting interest mechanism, the payments to this subordinated tranches can very well be stopped for some time until the credit quality is restored for this particular group. So the residential mortgage-backed securities have created a buzz in the market because of this pooling of the various securities, issuing the securities against those pool of mortgages as the collaterals, right? So after this, there is some amount of additional repackaging done on the top of this residential mortgage-backed securities into collateralized mortgage obligations (CMOs), which are built on the top of this basic structure of the residential mortgage-backed securities itself. All right. Now, let me look at this collateralized mortgage obligations, in short called as CMOs. These are the kind of securities which are collateralized by RMBS itself. They are like security of securities, and the difference is whatever the different CMOs that are getting created, right? Whatever the different CMOs that are getting created, they have multiple tranches, and each tranche is having a different exposure to the prepayment risk. The main objective in terms of creation of these tranches is the prepayment risk is getting structured out. The prepayment risk is getting structured out. So overall total prepayment risk is not changing, but it is redistributed among the different participants here, among the different sets of investors. It is redistributed. So because the investors wise, so it's basically trying to identify the investors of different categories, and based on the investors come different categories with different risk levels and different maturities and different investment characteristics, creating the products, structuring the products in such a way that some of them have a high some of them have an extension risk but a very low contraction risk, whereas some of them may have a very high extension, very low extension risk, but they may be having more and more of contraction risk. So trying to identify different kinds of investors who are having different kinds of preferences with respect to the extension risk as well as the contraction risk from the prepayments. So creating different kinds of packages and overall resulting in improving the accessibility towards the securitized mortgages, and also creating avenues where the investors can choose the product which can really fit their investment needs. So there are different risk levels, different exposures to extension risk, different exposures to contraction risk. So the packaging of this RMBS in such a way that it can attract different investors of different risk levels and overall reduce the overall funding structure itself, the funding cost can drastically be reduced through this kind of a structure, right? So whatever the interest and the principal that are coming from these mortgages, they are allocated to each of these classes in a different way. It may so happen that whatever the payment that is coming from this group, okay, interest wise, all these groups are paid based on the necessity, based on whatever they are promised. But any principal portion that is coming from here, it can so happen that first only this group will be paid the principal. Any principal that is coming in, right? It could be more, it could be less, it could be more than expected prepayment, or it could be less than expected prepayment. Whatever it is, whatever the principal that is coming from this group is first paid to this particular group only. And once this group is fully paid off, the principal will start getting paid to this group, and finally the principal will start getting paid to this group. Some kind of a structure like this can be designed with respect to the interest and the principal payments that are coming from the group of investors, from the interest and the principal payments that are coming from borrowers. They can be structured in different ways so that one party is getting the loan paid off very quickly, the other party is getting the loan paid off at a much later point in time. So the claim on the interest and the principal is repackaged for the different groups. So they have a different mixture of extension risk and the contraction risk. And that is what is the main purpose of the creation of collateralized mortgage obligation. So it is created in such a way that it matches the investment characteristics and risk characteristics of different kinds of individuals. So if I am looking at some of the common structures that are present in these collateralized mortgage obligations, one of the most common structure that is observed is the sequential collateralized mortgage obligation. So in this case, whatever the cash flows that are coming up, they are structured in such a way that the principal and the interest repayments are paid to these different groups. The cash flows for this tranche 1, tranche 2, tranche 3, if I am saying, the cash flows are paid in such a way that there is a sequential retirement of these bonds. So this particular securities, they will be paid off first, then it goes to the next, then it goes to the next. So the interest payments would be done as per the agreement itself, but the principal repayment will typically happen faster to this group and much slower to this particular group. Right, so the overall contraction risk, the extension risk will still be the same, but here we see different levels of, it's not a proportionate contraction risk and extension risk. Some of these groups are more exposed to contraction risk compared to an extension risk and vice versa. So if I am looking at the shortest tranche, this is the shortest tranche because the principal is paid off much earlier here. So it is because it is getting paid off much faster, it is more and more exposed to contraction risk, because if the prepayments are much faster than expected, this group will be paid off much faster. So the average maturity life, weighted average life period for this particular group is much lesser. So they are exposed more and more to contraction risk, but they are protected more against the extension risk. So extension risk may not exist too much, but they are more and more exposed to contraction risk. Whereas here it is quite the different. They are more and more exposed to extension risk. They are very much shielded against the contraction risk. So which means and probably these guys, they have moderate extension risk as well as the moderate contraction risk itself. So what we can typically see is, let me take a simple example to understand this entire process. So let's say I have taken a simple loan of 1 million right? The loan amount I have taken as 1 million, and probably we see that the interest rate, right? The interest rate is let's say around 9% per annum, and the number of periods I'll take it as 20-year loan. That's it. So based on this, I know that the EMI that needs to be paid, the fixed amount that the user is typically paying on this loan is somewhere around this. The going with the rate of 9% divided by 12, NPER 20 multiplied by 12, the PV being this much, FV being 0. I see that on a monthly basis there is a payment of 8,997 that is expected, right? Now what I want to see is, I want to look at the payments that are coming up in the entire 240 months period. In the entire 240 months period, if I am looking at how the typical payments are coming off, right, both the interest portion as well as the principal portion. Out of this 8997, I would typically I will look at what is the interest portion that is coming up in each of the periods. So I'll use something called IPMT kind of a formula, wherein I'll find out the interest part, right? I'm taking the interest portion out of this payment. I'm looking at the interest portion. All right. So the interest portion of this is going to be around 7,500, and I'm even computing the principal portion of it using a similar kind of a formula, right? I'm computing the principal portion. All right. So the principal contribution in the first month is 1,497, then it is 1,508, and so on. Now, let's say using this without any kind of an haircut, let's say I've created a sequential CMO, sequential payment based CMO, wherein I'm talking about two major tranches, right? In a sequential pay CMO, I'm creating two different tranches, tranche 1 and tranche 2. And this tranche 1 is carrying, let's say, out of this 1 million, so 750,000, let's say, is going with tranche 1, and the remaining 250,000 is going with tranche 2. Now what we are talking of is uh, the interest for the tranche 1, the payments, if these are the payments that are coming from the borrowers, the tranche 1, the interest part, I will always look at this interest portion multiplied by the ratio FO divided by the summation of this. So the interest portion is completely allocated to both the tranches in the same way. So the interests are paid off in this particular manner, whereas the principal for the tranche 1, whatever the principal is, the payment of the principal is going in the first let me compute the interest for the tranche 2 as well. So the tranche 2 will be getting the remaining portion of the interest. Tranche 2 will be receiving the remaining portion of the interest. So these are the payments that the tranche 1 and tranche 2 are receiving. Whereas when we are talking about the principal part, tranche 1 will keep receiving the principal now. So the principal that comes out to tranche 1 is whatever the principal that is coming from this particular payment. So principal is whatever the principal that is coming from this particular payment. Until it is exhausted out, it is being paid to the tranche 1 only. Whereas to the tranche 2, initially the principal payment is 0. So what is typically looked at is, as long as this principal, this amount plus whatever this amount. So I can look at the minimum of, or probably if I can look at, if this amount plus, as long as it is greater than 750,000, I can keep incrementing it. So simply I can look at it as this plus this. So if I take it just going ahead, what I see is in the initial periods, let's say until the 750,000 is reached, until this 209th month is reached, the principal repayment is going to happen only to tranche A, and only from this 209th month the principal will start flowing into the tranche B. Until that particular point in time, the tranche B's payment is going to be, the tranche B's payment is going to be only this much. So for that point, what I can very well do is I can write a simple formula saying max of this comma minus this. So if I'm just putting that particular amount, what I could typically see is, at this point the 750 is coming into picture. So wherever it is 750, which means it is from that particular period the payment is going to start for, the principal payment is going to start for tranche 2. So that is where we could see this structure of a sequential pay CMO getting created. Right, so initially the principal payment is 0 for the tranche, but it is going to receive the interest payments as per the requirement itself. But at the end of the period, the tranche 2 is going to receive the principal payments, but the interest payment can keep continuing the same way as well. So that's one kind of a structure that could be there. And there could be a slightly different kind of a structure. In case of sequential, the more and more prepayments are happening. Right now in this, the more and more prepayments are happening, the payment to the T1 tranche is becoming more and more faster. That's the reason it is getting more and more into a contraction risk. Whereas if the prepayment rate is going lesser and lesser, the T2 will take more time to receive its first amount, which means there is a lot of extension risk that is built into the T2 tranche, whereas there is a lot of contraction risk that is built into the T1 tranche. So what we typically see is the T1 tranche, more of contraction risk, less of extension risk. T2 tranche, more of extension risk, less of contraction risk. So this is the package. Whereas now there could be another kind of a structure in the CMO, one more common kind of a structure called as planned amortization class, packed tranche. What this is there is a group that is getting created, there is a tranche that is getting created, which will have both extension risk lesser, contraction risk also lesser. Whereas, so this kind of a tranche is called as a packed tranche, which will always be supported by a support tranche, which will take the risk both of the extension risk as well as the contraction risk. Now, how is this designed? Now, again, these cash flows, the payments, right? If I'm talking about these two tranches being created, let's say this is a pack tranche and this is a support tranche, right? The interest and the principal payments are allotted in some way to both these tranches, but the main process is if the prepayments are much faster, right? Here the difference is, let's say if the prepayments are much faster, instead of the whole amount being paid to this tranche and creating a contraction risk for this tranche, there is a set amount, there is a kind of a set limit which we call as the pack limits, pack bounds. There is a lower bound, there is an upper bound in terms of the principal that it can receive, and that is set in terms of PSA. So it can say the lower limit is 100, upper limit is 200. So based on this lower limit of 100, whatever is the prepayment that is expected, and based on this 200, what is the prepayment expected in the next month, they are computed. And let's say now the prepayment is coming from this party is more than 200. I mean, so based on the 200, let's say the prepayment that is expected is 10,000. If it is 100, let's say the prepayment is 7,500. If it is 200, let's say the prepayment is 10,000. Now what we are simply putting is, if it is 100, let's say it is around 5,000. If it is 200, let's say the prepayment is around 10,000. Now what we are simply putting up is, if the prepayments in that particular period have come to 12,000, so which means in the regular sequential pay kind of a CMO, the entire 12,000 would be transferred to tranche 1 only. Whereas here, only 10,000 will be transferred to tranche 1, the remaining 2,000 will be absorbed by tranche 2. Right? Similarly, let's say if the prepayment has slowed down, it has gone only with a 70, means only let's say 3,500 has been received. Whereas the minimum, the limit that has been set out is 100, which means 5,000 needs to be received as a prepayment. So the prepayments are slower here. So instead of just sending 3,000 to this tranche, 1,500 would be funded by this tranche to this tranche. So there is a funding from the support tranche to the principal amortization class tranche in case of a shortfall, which means any kind of prepayments that are coming up in any particular period here, it would be lying between 5,000 and 10,000. Anything lesser, it would be funded by the support tranche. Anything higher, it would be taken by the support tranche. So the support tranche is going up as a high risk taking kind of a group, because it is absorbing the extension risk as well as the contraction risk, right? So the larger is the support tranche. If the support tranche is much larger, there is a heavy protection that is coming out to this pack tranche. So whatever is the initial pack collar that has been set, which is the lower as well as the upper bounds, based on this lower and the upper bounds that are created as a part of the pack collar, anything lesser than that is funded by the support, anything more is funded by is absorbed by the support. And if things go much outside, that is where we are calling that as the broken back. As long as it is within that limit, it is simply adjusted to both the tranches. The moment the PSA is getting outside the limit, it is treated as a broken tranche, and either the risk has to be absorbed by the support tranche in terms of accepting more prepayments, or fund has to be transferred from the support tranche to the pack tranche, taking up the extension risk as well. So pack tranche, to a large extent, we see that the average life is within a particular period itself. But if the PSA is very small, we could see that the extension we could see that the extension risk is much higher for the support tranche. If the PSA is very high, the contraction risk is very high for the support tranche. So support tranche is exposed both to extension risk as well as the contraction risk, much more higher than the pack tranche. But for the pack tranche, at least as long as we are talking of the pack collar, 50 100 to 200 kind of pack collar, and the prepayments lying within that range, the average life is more or less constant. Whereas what we typically see for the support tranche is the average life keeps decreasing as the prepayment rates are going higher and higher. So there is no protection here. Whereas in case of pack tranche, what we see is in the initial, as the PSA is increasing, the average life keeps reducing, and for the PSA lying within a collar, we see that the average life will be constant, and after that the average life will be decreasing. This is the typical structure we observe for the average life with respect to the PSA for a pack tranche. Whereas for a support tranche, I look at it more and more steep. Within no time, I see that this is the way the average life will be falling in case of a support tranche. Initially, it would be much higher. Probably let me look at it like this. Initially, it would be much higher. As the PSA is increasing, the support tranche would be exhibiting more of this kind of a behavior with respect to average life. The higher is the PSA, average life is dropping drastically in case of a support tranche. So if the prepayments are much slower, here the average life would be higher, but this will have a much higher life compared to this. If the prepayments are faster, the pack tranche will have average life which is lesser, but at the same time we see that for the support tranche the average life will be even more lesser, which means they are exposed both to contraction risk as well as the extension risk. So these are the two major CMO structures that are created. They are having a wide amount of usability in the market. So understanding both the forms of CMOs, how we differentiate a sequential pay from a principal amortization class CMO, what are the specific characteristics associated with each of these structures is very important for us to assess the values of each of these instruments. All right. Now let's look at this commercial mortgage-backed securities. The key difference which I observe between the residential mortgage-backed securities and the commercial mortgage-backed securities is, to a large extent, the commercial mortgages, if I look at in general, the commercial mortgages are generally income generating kind of properties. So it need not be a commercial venture, even a apartment which can generate income, I can treat it as a commercial mortgage itself. So any income generating kind of a property, so a pool of those kind of properties and the mortgages that are linked with that kind of properties are typically sold to SPV, and this SPV is issuing the securities having these mortgages as the backup. So those kind of securities are typically being categorized as commercial mortgage-backed securities, right? So typically there could be multi-family apartments, there could be warehouses, there could be shopping centers, hospitals, offices, hotels. All these things come under the commercial mortgage-backed securities. All the securities that are issued having these as the underlying collaterals get classified as the commercial mortgage-backed security. And probably another difference that I see with respect to residential, in the residential, the mortgage payments, whether it is the interest or the principal repayment, generally done by the homeowners. Whereas in case of commercial mortgage, this kind of mortgage payment is done by the real estate people, because they are the ones who are building these ventures, and they are in turn giving them for various hotels, schools, any such kind of income generating kind of location, income generating kind of activities, right? So that's one key difference which we see. And even in general, when we talk about the commercial mortgage backed securities, to a large extent, these are created as non-recourse kind of structures, which means the lender does not have any hold on the personal assets of the borrower. The lender can have a claim only on this particular asset which has been collateralized. He can't have a direct access to the assets of the borrower. So which means assessing the credit quality of the borrower is not required in case of commercial mortgages. The assessing the credit quality of the property is a very important aspect in this case, because whatever the cash flows that come from this property, they are used for making the payments to the bond investors of the CMBS. Whereas in case of a typical residential kind of MBS, the payments are done by the homeowners, and to a large extent they are modeled as recourse loans, recourse structures, which means the claim can be done even on the personal assets in case the value of the property is falling lesser than the value of the amount that needs to be paid. So the credit risk is much lesser here, whereas the credit risk is going to be much higher here. So which means some kind of additional credit enhancements are also required to really entice the user, entice the investors to get in this kind of CMBS investments, right? So two important things, right? From a CMBS investor's perspective, there are two important things to really assess. One is the debt to service coverage ratio. So we are looking at net operating income, how much amount is available to typically pay the debt, right? How much of this income this property is able to generate, because this is a commercial property. It is typically based on the income generation. So we are trying to assess how much income this commercial property is able to generate, which we are calling as net operating income, as a percentage of the total debt amount that needs to be paid. So this net income, net operating income, based on whatever the revenues that I'm going to get, I'm going to subtract all the expenses that are associated with that particular property, including the property taxes, any kind of insurance, any kind of utility payments, all are subtracted to typically arrive at this net operating income. We don't take any kind of income tax out of it. So the net operating income is computed through this. I will check by how much this is more than the interest and principal that needs to be paid during this particular period. If the net operating income is very high compared to the debt service, it is an indication of the better security of that property. The risk is much lesser, and even the investors who have that kind of properties as a backup, they are having lesser amount of risk. But if this ratio goes much lesser than 1, it means that the property is not in a position to generate enough cash. So the probability of default will be much higher for that particular property. So while including that particular property as a part of the CMBS, the investment bank or the SPV which is introducing this has to look at the debt to service coverage ratio. Then apart from that, the regular loan to value ratio. Again, we have done it even in case of residential mortgages as such. The same logic, what is the loan amount? What is the loan amount that is outstanding divided by the collateral's value? So, the higher it is, the riskier it is. High means risky here because the loan that is taken is much higher compared to the collateral value. But if it is much lower, it's an indication of more security built into it. And again, this is worth involving this kind of property as a part of the CMBS structure, because there's a lot of protection. If this is much lower, which means the borrower is having a lot of equity stake in that particular property, so only he is the one who is going to absorb the losses in the beginning. If there is any shortfall in the payment, the borrower would be absorbing a significant amount of loss, and then only the loss gets transferred to the lender. So the borrower will try all his best to make sure that the default does not occur heavily. And once we look at the CMBS structure, again, just like in an MBS, there could be different kinds of tranches that are created out of the pool of the cash flows. Again, these tranches can have different access towards principal repayment, the interest repayment, depending on the risk and the return aspirations of the various investors. Each of them can carry a credit rating, just like a residential MBS. Even for these commercial MBS also, we see the rating agencies getting to credit ratings. And the tranche structure, senior subordinate kind of a structure. This structure will absorb the losses in the first set of losses, then it goes to this, and this kind of a tranche is the typical senior tranche, where the possibility of losses are much shielded. So this could be a junior tranche, this could be a senior tranche, and junior tranche could also be called like an equity tranche, which generally don't get even rated as well, because this is treated more like a residual. Whatever is left, this tranche is going to receive. So it may it's a very risky kind of a tranche, because it can get it may not get anything in some couple of periods, it may get more in a couple of periods, overall resulting in a heavy risk being taken by this particular tranche. And one more benefit the CMBS structure creates is a prepayment protection. Right, the prepayment protection, which is like a call protection. And a call option on a bond is actually beneficial to the issuer, because he will call back whenever the interest rates are lesser. So typically it will have a big impact on the investor. But if I'm saying call protection, the it is going to benefit the bond investor because it is stopping the calling process by putting some kind of restrictions. And the call in case of a regular bond is carrying the same concept towards the prepayment in case of mortgage-backed securities. So what I could clearly see is in case of MBS, if I call it as a prepayment protection, it is going to benefit the bond investor altogether. Now, how is this bond investor getting benefited through this? So that is where if I look at the prepayment protection, there are two ways to bring in this prepayment protection into the structure. One, we can put it at a loan level itself, each of the individual loans, each of the individual mortgages that are included into the CMBS, there could be some kind of protection at that layer, or there could be a kind of protection that is built in at the CMBS layer itself. And if I'm talking about the CMBS layer of protection, it's purely through the tranches, a senior subordinate kind of a tranche structure, each structure carrying a different amount of credit rating. So, at least for the senior tranche, there is a lot of protection that is getting built into it. Any kind of prepayment that occurs more than a limited, more than a decided kind of a range could very well be passed on to the subordinate tranches and vice versa, just like the packed tranche we have seen in case of a residential mortgage. So it can very well be designed. The CMBS structure, the tranches in the CMBS structure can very well be designed in such a way that the senior most tranche is completely protected from the kind of prepayments. Whereas when I'm talking about the individual loan level, some of the important things that can be brought out is a lockout period, which means we can very clearly, the loans can very clearly carry a kind of a notice that at least for the first few years, no prepayments can happen. Or in some cases the same, okay, even if it is going to have some kind of a prepayment, there is going to be a penalty. So it could be expressed in terms of penalty points, more like 1% of the principal amount, whatever is the points, that is equivalent to 1% of the principal amount. So some kind of penalty points can be levied in case the borrower wishes to prepay. So if he is planning to prepay 100,000 bucks, and if I'm talking about a point of 1%, I mean, if I'm talking about 1 point, then it is 1% of this. So a penalty of $1,000 would be levied on that particular prepayment. So there is some penalty points that could be brought in. In some cases, there is a good, interesting concept of defeasance, especially to make sure that the CMBS investors are not losing out because of this prepayment. Let's say the borrowers have done some amount of prepayment. So instead of passing on all these prepayment amount to the CMBS investors, it might very much be possible that there is a defeasance that is occurring, which means this entire amount, whichever is the excess prepayment, whatever has been received, it is invested in government securities. This amount, the SPV is going to invest this amount in the government securities for that much amount, so that the CMBS investors can be paid off comfortably. So whenever the maturity of these happens, the maturities are also decided in such a way that the CMBS investors need to be paid accordingly. And because the government securities are less risky, the credit rating for the overall process is going to increase the worthiness of the CMBS investment. So that is what is the defeasance process that is coming in. That's one more way you can do the protection against the prepayments. And finally, there could be something called as yield maintenance charges. Whatever is the loan, whatever is the interest that the lender has lost because of the prepayment, it has to be paid by the borrower. So it is more like a make whole kind of charge. So whatever, even if someone is trying to prepay it, you prepay it in such a way that the lender is indifferent. Right? That's a simple way. The interest, instead of saying 1% penalty, 2% penalty, make sure that, if I'm bringing in yield maintenance charges, the intention is to avoid people from doing the prepayment just to take the advantage of the falling interest rates and get the loan reissued at a lesser price. Make the existing lender indifferent to prepayment versus non-prepayment. So that is what we are calling as yield maintenance charges. So there is an excess amount that is charged from the borrower for that amount of interest that is lost by the lender. So making the cash flows equivalent is the main objective of this kind of a structure. So these are some of the things. And so this is how the prepayment protection happens. And just as a couple of other features, if I'm talking about a 20-year mortgage, what we say is generally the amortization, let's say, happens over a 25-year period. So the principal and the interest payments that are getting paid are generally based on a 25-year amortization structure. So which means at the end of 20 years, at the end of completion of this completion of this loan period, we see there is a balloon payment that is required. Some amount of principal is typically outstanding because the principal and interest actually need to be computed based on a 20-year mortgage, but generally it will be looked at from a longer term mortgage perspective. So either a 25-year or a 30-year structure would be prepared for a 20-year payment, which means by the time the 20 years is over and the loan is getting closed, there is still some amount of principal that is outstanding that needs to be paid, which is called as a balloon payment. And in case the borrower is not able to pay this, there is a possibility for extending the time period by the lender, but this can result in a higher interest rate during that particular period. And which means there is a possibility of the extension risk for the CMBS investors because of this particular characteristic. So this is one more characteristic which is very much significant with respect to commercial mortgage-backed securities, and this is one more point that differentiates between a residential mortgage-backed security and a commercial mortgage. So couple of important points to keep in mind. Any kind of mortgage that is included as a part of the CMBS structure, we look at the two key performance indicators: the debt to service coverage ratio, loan to value ratio. Right. So the debt to service coverage ratio focusing more and more on net operating income after doing all the payments divided by the debt service. The higher it is, the better it is. Generally, it would be in the range of 1 to 2. The loan to value ratio, the lower it is, the better it is. Right. So this value should be much lower. That is where a commercial mortgage backed security will generate a better customer set, and a good because of the risks that are built into the commercial mortgage backed securities. The call protection features that are being bundled into it really create a difference for it. Right, the more and more the call protection mechanisms are there, these will be treated more and more like a corporate bond, than like a residential mortgage-backed security. So either the CMBS structure through the various tranches should create this call protection or a prepayment protection, or it could be at individual loan levels in terms of lockouts or in terms of penalties or in terms of defeasement or defeasance, or finally it could be yield maintenance charges where we are talking of make whole the loss. So all these kinds of mechanisms can very well be operated out to provide the CMBS investors an attractive way of investing in the commercial mortgage-backed security. All right. Now we will be looking at non-mortgage asset-backed securities. While mortgage-based asset-backed securities called as MBS, one of the popular instruments because they deal both, they have two different significant products called residential mortgage-backed securities and commercial mortgage-backed securities. There are few other assets which can act as collaterals for issuing the various securitized products on the top of them. So the different other kinds of financial assets could come out in terms of different kinds of loans. It could be small business loans, it could be student loans, it could be automobile loans. So different kinds of loans that can come out, or it could be based on accounts receivables, it could be based on credit card receivables. So based on the receivables, so all these are sold to SPV. The concept will still remain the same. All these are typically being sold to the SPV, who in turn will create some kind of bond kind of instruments and raise it in the capital market. So these two kinds of instruments, which are either based on some form of loans or based on some forms of receivables, they are getting broadly classified as the asset-backed securities. So probably there are two different categories. One is the receivables based, the other is the loan based. But even in those things, what we generally see is one major product which is very heavily observed is auto loan backed asset backed securities, and the other one is the credit card receivables as the backup for the asset backed security. These are the two ones. Key ways. This is a fully amortizing, just like a residential mortgage. Just like a residential mortgage, I see the characteristic of an auto loan is generally a fully amortizing, whereas in case of a credit card, it is completely non-amortizing, but it can be more and more revolving as well. Because once you pay, you will get an additional credit limit. Again, you pay, another additional credit limit is going to be created. So it's completely non-amortizing. So just let's look at a few more things. When I look at it from an auto loan perspective, yes, vehicle loans, we see that they are taken anywhere between 3 to 7 years or 3 to 6 years, right? And lot of players give these kind of loans. It could be the companies themselves which have set up their financial subsidiaries, right? Financial subsidiaries of the automobile companies itself, or it could be commercial banks, or it could be any other entities that are offering the automobile loans. And if you look at the cash flows in case of automobile loan, we see that there is a regular interest that can come. There are principal payments because it works like a fully amortizing kind of a structure, and because of that there is a possibility of prepayments also happening. And in case of vehicle loans, the prepayments are because of various reasons. One, I've sold the car, and because I've sold the car, I can prepay it off. Or my car is stolen, so I have applied for insurance, and the insurance proceeds are typically used to pay off this loan. Or simply I had some kind of excess cash with me because Generally, the car is much cheaper compared to that of a property. So the cash, even if I generate something more corresponding, need not be that heavy. Even if I have some amount of cash with me, I can use it very well to pay off my loan. And so because of this, what we see is the prepayments are much more common in automobile loans, which means these things need to be very well taken care of while structuring the ABS product. And the riskiness also associated with the vehicle loans is much higher compared to a property loan, because the depreciation is very heavily applied to the vehicle, so the value of the vehicle can fall quite faster compared to that of the building. And it may very much happen that if it is a non-recourse kind of a loan, it might very well happen that a strategic default also can come into picture. So the ABS need to be considering all these aspects in an effective manner. And because of this, some kind of enhancements, credit enhancements are very much required in order to lure the investors to typically buy this ABS products. So just the traditional enhancements like senior subordinate kind of a structure. So I can create a subordinated tranche which will absorb all the risk. The senior tranche is completely risk free. The credit risk is more higher in case of a subordinated tranche, whereas much lesser in case of a senior tranche. The payments first happen to the senior tranche, then to the subordinated tranches. All this kind of a structure can very well be created. Or there could be various other internal credit enhancement mechanisms which we have discussed, even in case of residential mortgage-backed securities as well, wherein there could be a reserve account that could be created. Or we can talk about over collateralization compared to the worth of the vehicle that is being purchased. The loan that is being provided is much lesser, so that even if there is a fall in the value of the vehicle, it would be sufficient enough to recover the loan amount, right? So, and also assessing what kind of loans are to be included and what not to be included. We can have prime loans, the loans that are granted to those borrowers who have good credit ratings. Or we can talk about subprime loans. The loans are granted to those kind of borrowers who don't have a good credit rating. So depending on what is the profile of the borrower, what is the credit rating associated with the borrowers, what kind of ABS, what is the risk associated with the ABS can very well be assessed depending on what kind of automobile loans are included as a part of the ABS structure. So the cash flows are primarily based on the interest payments, the principal payments, scheduled principal payments, and the prepayments that are typically bound to occur. Whereas on the other side, when I look at from a credit card perspective, the underlying is the credit card receivable pool. Credit card receivables pool is the underlying asset that is purchased by the SPV, and based on that it is issuing the bonds. And even if I look at the typical cash flows that come in a credit card, one, there is interest that is getting paid on a periodic basis by the person who has borrowed on a credit card, typically called as finance charges. We talk about the principal amount, whatever is the amount that is taken on credit, that is typically being paid off. So there is a principal repayment and renewal fee and some kind of annual fees that is associated with this credit card. And there is a periodic payment schedule. Let's say every month some amount needs to be paid. There is some amount of a minimum amount that needs to be paid, but the moment the payment is occurring, again a new credit is getting generated, right? So that's the reason the principal amount, though it is received, it will not be passed to the ABS investors. Though the principal is received, it will not be passed on to the ABS investors. Rather, it would be used to purchase the new the new credit card receivable. See, like this. These are the various credit card receivables. They are all packaged, and whatever the payments that are coming from each of them, they are paid here. What typically happens in an ABS of this kind of a structure is the interest that comes here, it is made as a payment to the investor. But the principal that comes from here, the amount that is repaid, not the interest amount, the principal amount that is repaid, that is not passed on to the investor because it's a very short term period. So rather than that, it would be used, this cash will be used to purchase the additional credit card receivables, because this guy, once he had paid, he got a new credit again created. He can very well use that credit. So the moment he has used that credit, this would be again purchased by this SPV, which means it's a kind of a revolving system that is bringing in, because the balances keep revolving. The structure is designed in such a way that the principal is not being transferred to the ABS investors, rather only the interest is being transferred. So the interest whatever is received on a periodic basis is being transferred, but the principal that is received on a periodic basis is generally used to purchase additional assets rather than paying them to the investors. Especially there is a lockout period that would be created, and any kind of principals that have been received during the lockout period, they would not be paid to the ABS investors, rather they would be used to purchase additional credit card receivables. And so that the otherwise the overall principal value is going down and down and down within no time. But the moment additional ones are purchased, almost the principal value underlying the receivables is maintained more or less constant for a longer period. So once the lockout period is ending, then all these principal payments are passed to the ABS investors. And again, the credit quality of the various borrowers, and the kind of historical payment histories and all needs to be evaluated if I have to consider this particular product as a good option for investment. So the interest rates that are typically here, to a large extent they would be floating, because the interest that are received from the credit card borrowers would be on a floating rate. So even here it would be more and more on a floating basis, whereas in some cases it could very well be fixed also. And even the period of payment also could be decided monthly, yearly, quarterly, whatever. But the main underlying difference is the underlying pool is a credit card receivable where the principals keep revolving. Right. So the two major products that we see in case of the non-mortgage backed ABS in the regular financial market today are auto loan receivable backed securities and credit card receivable backed securities. Again, a key difference: automobile based automobile loan backed securities are more and more amortizing in nature, whereas when we are talking about credit card receivable backed securities, they are more and more non-amortizing in nature. And as with the residential mortgage backed securities, which are non-agency backed specially, external credit enhancements are very essential to make sure that it is more and more lucrative to the investors. So this is one more thing that we need to be comfortable with. All right. Now let's look at another important security, which is the collateralized debt obligation. So again, an SPV is coming into picture. Right here, the different kinds of debts and loans are what the underlying are, and using these as the underlying, the company is issuing some kind of bond securities into the market. So different kinds of debt obligations. So there could be a pool which contains corporate debt, corporate bonds, right? Or there could be some kind of emerging market bonds or loans. So this is one kind of pool that could be there, or there could be other kinds of pools which could be like a bank loans, more and more leveraged kind of bank loans. Now, if at all I am having this as the underlying asset base, I call the instrument that is thus created as credit collateralized bond obligation, CBO. And if I am having the loan pool as the underlying asset, I call it as collateralized loan obligations. So again, these are the offshoots of the collateralized debt obligation itself. But one thing we have to be very clear with respect to the collateralized debt obligations, where I differentiate them from the other ABS. Because in ABS also we said there is some kind of an asset pool, and based on that asset pool the bonds are issued. And the typical interest and principal payments from this asset pool are passed on to the investors here. This is where the difference is. Here, the interest pool, the interest from this various assets, various loans, they are not passed on to the investors. In an ABS, typical traditional ABS, whatever are the interest and the principal that are received from the underlying pool of loans, they are used for payment towards the ABS investors. But here the difference is whatever is the pool, the debt pool or the loan pool, the interest on this pool is not going to the investors. The interest and the principal on the pool is not going to the investors. Rather, every CDO is having a collateral manager. Every CDO has a collateral manager. He would be getting into buying and selling of all these securities. So there is an active trading of all the securities in the pool. So there is a kind of a capital gain that is created because of the active trading in the pool, and based on the outcome of that pool, the payments are typically being done to the various investors, which means traditionally it is not an asset backed security, because the interest and the principal, the cash flows of that particular asset are not typically being used to make the payments to the investors, but it is the buying and selling and the typical net cash that is generated because of buying and selling the assets in the part of the pool is what is the source of cash flow payments to the CDO investors. And from that perspective, we have two different kinds of CDOs that are popular. One is a structured finance based CDO, where the collaterals are primarily the asset backed securities, residential mortgage backed securities, or commercial mortgage backed securities, or any other CDOs, which means the collateral manager is investing in all these things, buying and selling these kind of stuff, generating the revenues, generating the capital gains, which would still be passed on to the investors of the CDO. Or there could be a synthetic CDO wherein the exposure to all these loan and bond instruments are getting created through the usage of credit default swaps on the various structured securities, rather than directly getting into the different structured securities. Rather than investing in these various structured securities, the synthetic CDO is more and more targeting towards the investment in the credit default swaps, which in turn are based on the default of the underlying entities as well. So from the way the cash flows are structured, more or less the same, the kind of tranches that are getting created, we see that the bonds that are issued, I can call it as a senior bond, senior tranche, or a senior bonds. I can have a mezzanine, which is in between the senior and the junior. and I can have a junior tranche or junior set of bonds which are more subordinated in nature, and this is more like an equity tranche. This will absorb the risk first, then the risk passes here, then it is here. This structure is more or less the same, and the return is more or less, the risk is lesser, so return is much lesser here, whereas the risk is much higher, so the return that is coming out, this is more like a residual. So whatever is left after paying to this set of people, investors, and to this set, actually lies with the residual itself. And this is where this excess whatever is generated, it goes to the CDO manager as well as to the equity tranche. So because of the additional risk that that group is typically involved in. That's the same thing that happens with almost any other kind of a structure. And when we are talking about the cash flows, from this cash flows, the bonds being issued, generally to this senior tranche, there is a floating rate that is being issued, not the fixed rate. And this tranche is a very significant 70 to 80% of the total cash flows are being allotted to the senior tranche. Then we have a mezzanine tranche. Probably this tranche could receive some fixed rate of interest, and anything excess after payments up to these two is typically going towards the equity tranche. And if at all, here from here there is a huge pool, the bonds and the loans. Let's say if they are paying more and more of a fixed rate of returns, then probably the collateral manager can very well, collateral manager who is a part of the SPV here, can very well get into an interest rate swap, convert this fixed rate cash flows into floating rate, so that the matching can happen with respect to the payments towards the senior bond investors. So interest rate swaps can very well create that kind of a cash flow matching, and in some cases, even the trades can happen as an arbitrage based CDO itself, wherein the CDO is primarily interested in encashing on the spread, funding costs, and the portfolio returns. These are the funding costs, these are the portfolio returns. So the intention of this entire CDO is to take an advantage of the difference between these two costs, and that is what is the profit that is generated by it, right? So this is how a typical credit collateralized debt obligation gets created. It's not an ABS because of the non-dependence on the interest that is getting generated out of the pool of the assets, right? So any diversified pool can be used here. A part of ABS, part of RMBS, part of CMBS, any kind of a pool can very well be used. Corporate bonds, emerging market bond, any kind of a pool of bonds can be used. So, but the entire thing is done through an SPV itself. The major difference being, in case of a CDO, we are talking about buying and selling the various securities in the portfolio rather than depending on the income that is generated by the assets underlying the pool. Right. So anytime we see as a structure of the CDO, we will have a senior tranche, a mezzanine tranche, and a subordinated tranche, which is otherwise called as an equity tranche itself. All right.